President Donald Trump moves to oust Federal Reserve Governor Lisa Cook from her post due to allegations of mortgage fraud. The unprecedented move is raising investor concerns around the central bank's independence. Live from Sydney, this is Insight with me, Paul Allen, where we dive deeper into the stories that matter with crucial context and sharp analysis. The dollar weakens and traditional haven assets gain after Trump's move to oust Fed Governor Cook, escalating the president's feud with the central bank. We'll get you reactions from a former advisor to Dallas Fed President and QI Research CEO Danielle DiMartino Booth, also Javelin Wealth Management partner Polka Mishra. Trump also threatening to impose fresh tariffs and export restrictions on advanced technology and chips in retaliation against other nations' digital services taxes. And Indian stocks struggled to shake the pessimism ahead of the imposition of the 50% tariffs, officially set to go into effect soon. Our top story today, President Trump moving to fire Fed Governor Lisa Cook over allegations she falsified documents on mortgage applications. The move is Trump's latest in his pressure campaign to get the Fed to cut interest rates and opens the door to securing a majority for his appointees on the 7-member Fed board. Well, markets are reacting on the back of this news very much as you would expect. Seeing quite a lot of red on the screen there. We've seen some declines for the US dollar. S&P futures also pushing down by about 0.1%. One beneficiary, bottom of your screen there, yes, it's gold. Haven demand propelling gold higher by 0.25%. $3,374 an ounce right now. Okay, let's get some insights on this story from our panel of guests. Danielle DiMartino Booth is a former advisor to the president of the Dallas Fed. She's currently CEO and chief strategist of QI Research. And joining us from Singapore is Polka Mishra, partner at Javelin Wealth Management. Thanks for both joining us today. Danielle, I'd like to start with you. Simple question, really. Is this move even legal? And could we expect Governor Cook to challenge it?
From everything that I've read, and I am not a legal expert, there is indeed the opportunity for Governor Cook to immediately go to the courts and ask for an injunction such that she stay in her position while the courts decide what the path is going to be. Again, I'm no legal expert, but everything that I've read this evening since this news hit suggests that she can indeed make every attempt to stop this right now.
All right, well, let's get you out of the legal weeds and onto some firmer ground in terms of, the market implications here. I mean, does this say to you overreach? How dangerous is this kind of move?
Well, when you consider the number of individuals, the two dissents, Michelle Bowman, Christopher Waller from the July FOMC meeting, the fact that there's another nominee who could get really confirmed before the Fed next meets in mid-September, and now a potential fourth individual to the Federal Reserve Board. You're talking about a majority here, potentially, again, of 4-3 on that 7-member Board of Governors. I can't overemphasize enough the import of this, because it's not just sway over the Federal Reserve Board, but indeed individuals who run the district banks around the United States of America. The Board of Governors has to sign off on each individual before they are appointed in each of the individual 12 districts. So this could carry deep, deep significance in terms of the ability of President Trump to theoretically stack the Federal Reserve and the Federal Open Market Committee.
Well, let's get to some of the market reaction on this. I want to get to Polka Mishra there in Singapore. So Polka, the reaction been very much as one might anticipate. We've got every major equity market in the red right now. The dollar weaker, gold is higher, treasuries have gained as well. So look, when it comes to Fed independence, even the suggestion of political interference, is that enough to make markets very, very nervous?
Absolutely, Paul. I think we talked about it earlier as well. It is one of the biggest risks that we are facing the market at this point. We saw earlier when Donald Trump attacked Jerome Powell, I think it was in April, and markets reacted very sharply, and Scott Bessent had to come down and calm down the market, saying, no, nothing's happening to Jerome Powell's tenor. So it basically makes investors question the fundamentals on which the U.S. market is built. It is one of the pillars that provided the stability, which is the Fed independence. And that happening at a time when investors are already grappling with fast-changing, haphazard policy making, tariffs being announced every second day, being taken back, Taco, it dents investor confidence even further, and investors will and have been looking at moving more and more away from the United States.
Do investors and markets have some power over this, however? Because you mentioned before, we have seen Trump reverse some policies. We now have the infamous acronym, maybe the acronym of 2025, TACO, Trump always chickens out. And we've seen him back down before when he saw the bond market get, in his words, yippee. Could we see, is there potential here for a market tantrum or a meltdown, and could that potentially cause a back down or a reversal?
It is. If you look at both short-term and long-term reactions, it happened. It's exactly as you said. Trump thought that, as the president, he can say and do whatever he wants with the Fed, and markets reacted sharply. It's when the longer end of the curve got impacted, and that seems like the trigger point. When that gets impacted is when the pressure is back on the White House to maybe back off a little bit. So it is a natural correction. If investors are reacting, money is flowing out. It really also starts to question the longer debt and the long-term viability of the U.S. debt. It is increasing every year, and the cost of servicing that will increase further as investors start to demand more and more premium. And with that big, beautiful bill, that's already a risk to the market, and this exaggerates that further. But if you look at it, at some point, investors have to think that, okay, market correction will push back a bit, but at the end of the day, this is an ongoing saga. This is a trend, and you need to diversify away from the U.S. dollar, which is happening, and we've seen that with the move towards gold, central banks piling up on gold, trades happening in different currencies. So that move away from dollar, move away from U.S., the U.S. is going to have to pay a lot more premium for holding its debt. So there is a trend that will still continue in the long run, even if in the short run you get some correction, because this is not stopping.
Danielle, I want to return to you. You were a former advisor to the president of the Dallas Fed. Can you perhaps give us some idea of what sort of conversations might be taking place at the moment among staff and among governors when it comes to interference and the impact on Fed credibility?
Well, so I was inside the Fed for almost a decade, and I can tell you that independence in and of itself, the ability of each district to choose who leads them, who's going to be the president of each individual district, the idea that Federal Reserve governors should have a majority of Senate votes, not be votes that are along partisan lines. These are all sacrosanct. And they're very much cherished at the Fed, even though there has been a lot of politicizing of the institution over the years. The idea of direct interference, I should say, would be seen as being existential, an existential threat to every district, an existential threat to the Federal Reserve Board, and an existential threat that I think the U.S. Supreme Court in May tried to indemnify, tried to make sure that it would be safeguarded by reiterating that individuals on the Federal Reserve Board cannot be fired for anything other than cause, which of course we're now seeing President Trump try to make a case for. But again, there are some very, very serious discussions that are happening, I can promise you, across the nation because of the threat that this is posing.
I Ultimately, though, all Fed governors are political appointees and all do require confirmation, as you were describing a little bit earlier. But is that necessarily a guarantee that a Fed governor is going to act to the political leanings of the person who appointed them? I mean, obviously, Jay Powell is a Trump appointee, and he's getting a lot of heat from the president for not behaving as President Trump would like him to.
So, Paul, I actually think you bring up the most important question, and I thank you for asking it. Just because somebody is appointed by any individual does not mean that they are necessarily going to betray their leanings, betray their beliefs when they do happen to be actually on the board. And I think that that is something that we should bear in mind. Christopher Waller, Michelle Bowman, they've all had independent voices of their own in the past. Just because they dissented once certainly doesn't mean that I think you can presume that they're going to be joining Team Trump, so to speak, and be against Powell. I think each individual's integrity should be unquestioned until they're viewed as being overtly political. Paul, again, you're asking the most important question. Just because you're confirmed by the U.S. Senate does not mean that you're going to kowtow to what the administration or the president would like for you to do once you're actually in that position.
Yeah, Danielle, we're just hearing now, according to the Washington Post, Lisa Cook says she will not resign. She disputes President Trump's authority to fire her. She also says that no cause exists for the president to fire her either. This is according to reporting from the Washington Post. So Lisa Cook refusing to step down and disputing the president's authority to force her out. Polka, I do want to return to you now for some more thoughts on this. I mean, what's the more urgent concern for the Fed at the moment? Threats to its independence and credibility, or is it just good old inflation and employment data as we count down to that September meeting?
So I think to Danielle's point, I would like to add there that there is the point around not questioning the integrity of the governors and that they will act in according to their responsibilities. However, investors are a little more fickle than that. Investors get more worried about it. So it's also about what signaling this is sending is very important to keep in mind when you're thinking about market reactions. In terms of the September meeting, I think one rate cut is baked in, 25 basis points. I don't think that there will be much, there won't be too much of an inflation surprise to change that decision. Labor market, it's not weak, but it is showing signs of weakness. So it is probably the right time for the Fed to not be too behind the curve on that. But this actually throws, this action this morning throws a lot in the spanner in which you question the decision that the Fed is taking. Is it under pressure from the White House, and is that why this decision was taken? So there's going to be a lot of questions that will be raised by investors, and the decisions will be made based on that.
Does any of this political pressure cause you to adjust your thinking around rate cut bets and timing, or like the Fed, are you just continuing to look at the data and look at market conditions?
No, we have to look at everything. I mean, all this plays a role in it. I think markets will factor in a more dovish Fed going forward, especially after Jerome Powell's term is over. And there may be some euphoria in the market because of expected lower rates in the short term. Because remember, there's the short-term traders, there's the long-term investors, but the risk to the longer term, and we are long-term investors, we are more concerned about what it does to the U.S. economy on the whole.
Danielle, I just want to end this conversation with some of your views. There's a move against Lisa Cook. She's refusing to go. Once this is over, though, do you suspect there might be more pressure on other Fed governors to go? Or do you suspect President Trump, if he manages to secure a majority of his own appointees on the board, that will be enough? When are we going to see the end of this is basically what I'm asking.
Gosh, Paul, I wish I could even begin to venture a guess as to when we see an end. 12 months ago, I would have never thought that I would have seen this happen, much less see the head of the Bureau of Labor Statistics be called down from her post as well. To Polka's point, everything right now makes us very nervous, including whether or not there's a next person who may or may not be in the crosshairs, and for that matter, whether or not we're going to be getting good data coming out of the new Bureau of Labor Statistics as early as September the 5th. So many open questions. I wish I could be more definitive on what the U.S. president is going to do next.
All right, Danielle DiMartino Booth, former advisor to the president of the Dallas Fed. Thank you so much. And Polka Mishra of Javelin Wealth Management. Please stay with us. We've got plenty of other market news to discuss as well. But just to recap for you, the big breaking news of this hour, Lisa Cook, Fed governor, says she is not going to resign. This is according to reporting from the Washington Post. She disputes President Trump's authority to fire her and force her out. She says no cause exists for Trump to fire her. So Lisa Cook making it pretty clear that she's not going anywhere. Still to come on Inside, President Trump vowing retaliation against other countries' digital services taxes that hit American tech companies. We're going to discuss the market implications of that next. This is Bloomberg. Welcome back. You're watching Insight. President Trump has threatened to impose fresh tariffs and export restrictions on advanced technology and semiconductors. This in retaliation for other nations' digital services taxes, which he claims are designed to harm or discriminate against American technology. He also alleges that the digital taxes give a complete pass to China's largest tech companies. The president's latest act of trade brinksmanship raises fresh uncertainty over tariff rates for U.S. trading partners. The Polka Mishra, partner at Javelin Wealth Management, is still with us. Polka, plenty of news coming from the White House for markets to ponder today. When you heard that, did it cause you to rethink your strategy around tech equities at all?
A little bit. It's not just today, it's every day, isn't it, Paul? We just look at what's coming from the White House. So, yeah, it's yes and no. We do feel that there is a bit more leg to the whole AI story and the tech story overall. But it's going to continue to be choppy given the noise that we keep getting. We saw earlier NVIDIA had to make adjustments with the 15% revenue share for exporting to China. So I think it's still, again, about deal making. Canada did give in on the digital tax, but Europe is holding firm. So it's again, we feel that you can't make long-term predictions based on a tariff being announced or threatened now and then being taken off again, or some deal being struck. So I still think that it's probably going to be, again, a negotiation, some deals being struck, but it's not going to impact the AI rally or the AI story significantly. There's still quite a lot to happen there. IMF recently I think predicted 0.5% of global GDP to come from AI. So there's a lot more to happen there. But yes, all these are impediments, but not complete roadblocks.
Yeah, you're doing a great job of channeling the public mood there, I think. But in terms of the impact on AI stocks, we will hear from NVIDIA this week. But to what degree is politics becoming a key risk for NVIDIA and other major tech companies?
It is, and especially at that size, at that scale, U.S. and China have still not agreed to their deals, although China hasn't given in to U.S. tariffs. It's standing firm. So it is going to continue to play in. We had 10% stake in Intel to try to revive Intel. I don't know how that will pan out. It is getting political, but at the end of the day, markets have their own way, and supply-demand cannot change. There is innovation happening in China. You cannot continue to ignore that. You cannot stifle that. So it will correct itself. At the end of the day, the pace at which the development is happening in this sector and the adoption that's coming through, even though we're not yet seeing profitability, we're beginning to see productivity gains slowly filter into the industries. So this is an important space. It will fight its way through these politics. It is at this point the core focus, the level of investment that is going in, whether it is from companies, whether it is from countries, it is a main focus area. So it will strike through. It's just going to be a little bit choppy, I think.
Well, just as we've been talking, we've seen Chinese indexes tick into positive territory. CSI 300 now are up by about 0.1%. But overall, we've seen quite an impressive rally in Chinese equities this year, and the tech-heavy Star 50 index in particular has rallied pretty strong. But there's a lot of other factors at play in China at the moment. And when you run your eye over this kind of rally, how durable does it look to you? Is there a risk of a pullback?
There always is a risk of a pullback, and sometimes a strong pullback in China. Chinese rallies are never one directional. We've seen the market has always been volatile. Some of it is also driven by the DeepSeek announcement that came through on the development. There were concerns around NVIDIA's ability to export to China. So all that has helped the rally. There have been more concrete, announcements around support to the property sector, which has been a big concern for investors. So that's also driving it. China is still providing us around 5% growth. Exports are stable. Yes, it's deflationary, so it has domestic problems, but at that scale of an economy, a 5% growth is still attractive. Valuations had been quite attractive. This rally makes it a little less attractive, but I think it's still at the average of the last 5 years or so. So it's not looking expensive as compared to other markets. So there is still relative value there. So I wouldn't say it is toppish, but yes, there could be short-term correction, but there's more more room for growth in China.
Before we let you go, Polka, just quickly, we're within 24 hours of seeing the US place additional tariffs on India, would take the tariff rate to 50%. How seriously do you take this? Because India's got a very compelling domestic story to tell as well. Is this affecting your strategy at all?
No, we remain bullish in India. The bigger focus for us in India is right now the GST reforms that are expected to come through in the next month or so. That will put more money in the hands of the consumers. Middle income group is very important for India, so that's a bigger problem to solve. With regards to the tariffs in India, it's U.S. exports is less than 2%, or somewhere around 2% of the GDP in India, and a lot of it is pharma and electronics. So the impact is not that significant. Additionally, of course, there's the concern around the Russian oil, but now that we've had the Alaskan summit, again, you don't know how much of it is economic and how much of it is political posturing, so there may be deals struck there, there are conversations. So less of an impact on India from the tariffs. The GST reform is more important because India needs to not revive, but push more money into the hands of the middle income back home.
All right, Polka, Mishra, we'll have to leave it there. Thanks so much for joining us. Polka is partner at Javelin Wealth Management. All right, let's take a look at how US futures are tracking at the moment, because, of course, in the past 20 minutes or so, we did get the news that Fed Governor Lisa Cook is disputing President Trump's authority to fire her. She says she will not resign, and she also says that no cause exists for Trump to fire her either. So this is according to reporting from the Washington Post. Not really moving the needle, though, in terms of US futures. S&P futures still currently negative by about 0.1%, and it's a similar story across most of those major markets that are open. Still to come, South Korean President Lee Jae-myung lays on the charm in his first in-person meeting with President Trump at the White House. We'll tell you whether it worked or not next. This is Bloomberg. Welcome back. You're watching Insight. President Trump has refused to change the terms of South Korea's tariff agreement, despite lobbying from President Lee Jae-myung during their first in-person meeting. After talks at the White House, the two leaders did agree to cooperate on security issues and shipbuilding.
We're going to be buying ships from South Korea, but we're also going to have them make ships here with our people, using our people. And we're going to go back into the shipbuilding business again.
Our Chief North Asia correspondent, Stephen Engel, joins us now with more. So, Steve, what stood out for you from that meeting?
Well, it was fairly cordial because the precursors to this meeting in the White House were sort of negative. Donald Trump had posted on Truth Social, on social media, before the meeting that he was concerned about doing business going forward with the South Koreans because of the political uncertainty, the purge, as he called it, and revolution and raids on churches in South Korea. Well, the two gentlemen cleared all that up. Essentially, President Lee came to the White House on a charm offensive and, struck a fairly cordial relationship with Donald Trump. He praised the stock market gains in the United States. He praised Trump's peacemaking efforts. He even talked about the golden touches adorned in the White House that Donald Trump has made those changes, as you can see here, quite gilded in the Oval Office. But again, there was a lot at stake for the South Koreans because they did try to bring down that 15% tariff rate that Donald Trump has placed on South Korean goods. It is down from 25, but the President Lee tried to make the argument it should be much less, if not zero, because of the contributions that the South Koreans are making and also pledging, investing about $350 billion into the United States over multiple years. We did get a couple of deals announced. Hyundai Motor is going to increase its investment in the United States over the next few years to 2028 by some $5 billion to $26 billion. And also, Korean Airlines has pledged to buy 103 new Airbus aircraft.
Steve, President Lee also raised the subject of North Korea with President Trump. Let's have a listen.
Okay.
I hope that you will usher in a new era of peace on the Korean peninsula. Resolving this issue through my engagement is not an easy thing, and the only person that can make progress on this issue is you, Mr. President. If you become the peacemaker, then I will assist you by being a pacemaker.
Some flattery there. Steve, what are we to make of this?
And I think Donald Trump, with his wry smile there, kind of appreciated that overture because Donald Trump clearly wants to be seen as a peacemaker, not just a keeper of peace. And that's something actually President Lee said. You're not just a keeper of the peace, you are a peacemaker. But again, there are many different moving parts to this. There is the opportunity that Donald Trump says he'd love to have another meeting. Of course, he met 3 times with Kim Jong-un in his first term in Singapore, in Hanoi, and then again at the border of North and South Korea. He says he'd like to do it again. We know that Donald Trump is going to be heading to Korea for the APEC meetings at the end of October. I'm not saying that could possibly be the date and time, but I mean afterwards or on the sidelines of APEC. But again, that is one possibility. And then again, the other side of this is where does the security alliance go forward if they are going to be engaging with North Korea? What is the equation going to be for those 28,500 U.S. troops that are stationed in South Korea? Donald Trump has been highly critical of South Korea for not picking up its end of the bill for those soldiers there. They didn't resolve that other than to say that they are going to jointly modernize the military response and the military presence in South Korea. Now, the South Koreans, we know, are going to be spending about 2.32% of GDP on defense budget this year. The White House sources have told us that is the Trump administration would like about 3.8%, so a sizable increase. That was not resolved at this juncture, but again, it's going to be an ongoing discussion, especially in light of this potential overture that the two gentlemen might want to make towards Kim Jong-un.
All right, Chief North Asia correspondent Stephen Angle there. Well, Fortescue shares are under pressure today after the world's fourth largest iron ore miner reported a 41% drop in full-year profit. CEO Dino Otranto spoke to us about those results as they grapple with stalling demand from China.
We have been impacted by a downside in the iron ore price on the full year. However, our underlying results that we announced today were exceptionally strong, meeting guidance at the top end on both safety, production and costs. And at a price point of around $100. It's a really good price for us as a business.
I'm not sure how the best way to describe it, but some would call it weakness in the market. Why do you think prices have remained fairly stable at a fairly elevated level?
Yeah, look, I mean, I heard the term weakness around the market in China, and I've heard it for a number of years now. I frequently visit China. I'm heading there this evening again, and every time I'm just in awe of the development that continues to go, really unwavered. What we're also seeing is a much more diversified and mature sector, really growing out of what drove iron ore demand, which was the property sector. You're seeing that somewhat plateau now, and it's being more than replaced by automotives. You're seeing the EV penetration in China, just phenomenal rates, and most recently the announcement of the mega dam project on the inner west of China, 3 times the size of the Three Gorges project, which we thought was the biggest project we'd ever see. 3 times will spur growth over the next 10 to 20 years for commodities like ours. And I think that really is the story around the price support that we're seeing in iron ore.
Dino, are you confident then that Beijing has the right policy settings and tools in place to really kind of boost demand in China?
Well, for me, it's not only future directed policy and regulation, but what we're seeing on the ground now. Last year alone, $1 trillion of investment in the energy transition. That's more than 400 gigawatts of solar, wind, battery, electrical infrastructure. All of that requires a lot of steel. And I can see that continuing now for the next 10 or 20 years as China commits and really doubles down on its peak carbon emissions. Many would say that it's already reached peak carbon emissions, and the downward trajectory over the next really generation that we are certainly encouraged by the supply into that process for iron ore and some of the other businesses that we're involved with.
From a demand perspective, that's really not as appreciated in the market, so thank you for doing that. They've also been tinkering with supply. You know, this whole anti-involution campaign, we talk about it a lot here in shows on the consumer perspective, but, you know, the steel mills, for example. I wonder, you know, what you're hearing from your contacts in mainland China as far as steel capacity is concerned, and what's your outlook there?
Yeah, certainly a new word I've had to add to the vocabulary, anti-involution. Finally understand what it really means. But for us, you know, from the demand side of the steel mills, you are seeing some structural reform, which is largely expected as the blast furnace enter now into the retirement phase and being replaced by electric arc furnace. Also a vision around China around moving some of those higher emitting polluters outside the country or further away from the mega cities of Shanghai and Beijing. On the supply side, I've always maintained the view that iron ore mines will get lower and lower in grade and smaller in sizes. So big projects like Simandou, our own project in Gabon, become more replacement in nature than adding more supply side pressure. So we believe that the market is quite well poised for largely a sustained price support model over the next 5 to 10 years.
That's Fortescue CEO Dino Otranto speaking earlier on the China show. All right, coming up, we're going to be counting down to the India Open. Markets bracing for those additional tariffs from President Trump due to happen in just over 24 hours. Seeing a little bit of softness in the pre-market there in India, but it really does reflect what we're seeing going on in the broader region. Most major markets in softer territory with the exception of some modest gains in China. While those tariffs are due to come into effect, it seems like consumption tax is the bigger domestic macro driver for India at the moment. Anand, Rathi Wealth's Shweta Rajani is going to be joining us next with a closer look at India's underperforming markets. This is Bloomberg. Welcome back. Indian stocks are likely to extend a rare underperformance compared to their emerging market peers as trade tensions with the US show no signs of abating. Asia equities reporter Ashutosh Joshi joins us now from Mumbai. So Ashutosh, equities in India have been trailing Asian and emerging market peers. What can we expect for what's left of 2025?
Yeah. Good morning. Uncertainty over tariffs remains the major factor dragging down Indian equities this year. On Wednesday, when 25% additional tariffs will be active, the total levy will be 50%. And it means a major impact on Indian industries that are exporters to US, such as garment, textile, jewelry, auto suppliers. With this tariff coming, these companies will be in focus because it will become very difficult for them to continue exports to US, and that will impact their top line as well. Indian equities have been underperforming for various reasons. That includes slowing earnings growth with issues related tariffs continuing. It will impact India's earnings recovery more, and that leads us to say India's underperformance over the rest of emerging market and Asian equities will most likely continue for the rest of the year.
How about the impact on India's growth prospects? How are tariffs going to impact that?
If a 50% levy continues, economists are penciling for 0.5 percentage to 1 percentage point impact on India's GDP for the full year. It will mostly come from impact on the corporate side, since a number of industries earn their revenue through exports to the US. Some of Indian companies are biggest suppliers of garments and textiles, such as bed linen to stores in the US. With 50% tariff, their supplies will be impacted. We will also see some sort of job losses because of these levies, leading to impact on overall economic growth.
All right, Bloomberg's Ashutosh Joshi there. Well, let's just check. Indian market's been up and running for a few seconds now, and we've seen a fair bit of weakness on most markets around the Asia-Pacific, and that's the story in India as well. Just off by about 0.25% at the moment. The Sensex down by, 0.25%. Similar story for the bank index as well. And we are tracking those Indian lenders. The government has reportedly hired Goldman Sachs to help sell part of its $3.3 billion in stakes at those banks. So although the bank index is a little bit softer, we're seeing some of those big financials moving higher at the moment. UCO Bank leading the way there, better by 0.8%. Well, tariff countdown keeping Indian stocks on edge. 50% tariffs are going to kick off in less than 24 hours from now. Well, joining us now is Shweta Rajani, head of mutual funds at Anand Rathi Wealth. Shweta, thanks so much for joining us. Obviously, we've seen this coming. Those tariffs now just 24 hours away. How have you positioned for this? And as we've seen with previous trade conversations, things do end up getting resolved. What are your expectations going forward?
Good morning, Paul. So like you said, the tariffs are here to kick in now, but a lot of this is already priced in the market movement or the market sentiments, like we've been seeing in the last few weeks, where markets pretty much been range bound. Our computation shows that, even if you take the 50% tariff and you look at those certain sectors, which is mainly your textiles, gems and jewelry, auto ancillaries to be the top ones to get impacted, the overall impact on the GDP should be around 0.3 to 0.4%. And practically, if I see on the corporate profitability for the top 500 companies, it should be around a 2% hit on the profit margins. Now, this is the worst case scenario. You are assuming that negotiations would not take place. You would expect exporters not finding other markets or other channels of exporting. Then this would be the scenario. However, a 0.3% impact is not so significant, I would say, given that the domestic macro, even at that end, even if you're talking about a 6.3% kind of a real GDP growth, given how the global growth is slowing down, would be relatively better placed compared to a lot of your world economies. So therefore, from a relative comparison perspective, as well as the domestic macros, a lot of it fitting into the right spots. Still, I would say, given the short-term volatility that one may expect in the market, the medium-term outlook still looks positive for Indian equities.
Yeah, so the Prime Minister's office is going to be holding a meeting on tariffs today. Do you think this situation demands any sort of fiscal response or a monetary policy response from the RBI?
So, if we talk about the monetary policy, the first half of the year, RBI is actually upfronted it so that there could be a transmission of rates with 100 basis points of a rate cut already done. At this point of time, the central government is also looking at boosting consumption. So the entire focus right now is that you boost consumption so that some bit of the offset of higher tariffs take place, as well as whatever is good for the country in terms of negotiations is what parallelly they would be talking about. In terms of at this point of time, if we see, we are trading on that thin line because with a GST rate cut, we could already see some potential fiscal slippage, which has to be balanced out with volumes increasing and other revenues going up to maintain that fiscal discipline. So yes, there's very little that ways that the government could do. On the other hand, you also have inflation, which is supporting and giving a required cushion to RBI to do maybe another 25 to 50 bips of rate cut. But we'll have to see how, by the end of September, the borrowing calendar comes out in October, November, what the data is suggesting. And post then is where we could expect any monetary action.
Yeah, what's the bigger concern for you at the moment? Is it tariffs or is it something else? And, of course, there is a proposal to reduce consumption taxes and, as you described there, that there's the potential for some fiscal slippage. So is that a more important driver than the trade environment?
So I would say at this point of time, a lot of your tariff increase is priced in. What matters more at this point of time is the corporate profitability. There, it's not as bad as it's been spoken about, especially in the segments of large and mid cap. We see that large caps have been growing in single digits. The first quarter result, for the financial year was just released. The large caps have grown at around 7 to 8%. Mid cap segments growing at double digits. So that's a sweet spot with, however, valuations being a mixed bag there. Small cap, somewhere in terms of profitability has yet to catch up. But while you have, profitability is something to be watched more closely, I would say, valuations and pockets are still supportive. So that, I guess, is going to be a bigger trigger to watch out for rather than the tariffs. Tariffs right now, in the sentiments, what we are seeing in the flows that we are seeing is somewhere pricing in for a higher tariff rate than what was expected probably in March or at the beginning of the financial year.
Shweta, just want to get your views on moves we've seen in the bond market as well. The government bond market saw a pretty sharp sell-off since last week, with yields rising close to 20 basis points. What's driving the selling pressure, and how long do you see it lasting?
Sure. So what happened in the first half of this calendar year was RBI upfronting rate cuts, doing 100 basis point of repo rate cut, as well as RBI doing a lot of bond borrowing, which was pushing down the yields. But in the last few weeks, what has turned around is RBI changing its stance from accommodative to neutral. Neutral basically means that RBI is going to watch the data very carefully and then accordingly take actions. The market is reading as, the rate cut cycle seems to be over. That's one thing. Second, with the GST rate cut announcing the probability of some fiscal slippage, which could come in and therefore increase the borrowing in the second half of the year, is what is pushing up the bond yields, and therefore even rating upgrade by S&P could not hold on to the yield hardening that we have seen. We've seen around 30 bips of rate hardening already in the last few weeks. But however, I think this is temporarily. Once by the September end, the second half of the calendar is announced, the kind of supply that could come in, whether it's towards the shorter end of the duration or the longer end of the duration, as well as where the inflation comes in. Right now, the CPI has been at 1.55, the lowest. So that's providing a cushion to RBI. So what RBI stance could be at that point of time is where we could see some reversal in the bond yields, where there is the 20 to 30 bips of hardening that we've seen. There is easily scope of that to reverse. But yeah, this I would say would continue towards at least till the end of September like this.
Mm-hmm. Okay, so what's your preferred positioning around duration at the moment?
I would say at this point of time, till clarity emerges, being in the short to medium duration would be a good idea, especially if your investment horizon is a year or less than a year kind of a period, and you don't want to go very aggressive with your debt positioning, debt portion of the portfolio. Then being in that 1 to 3 year bucket ideally would be a good strategy at this point of time.
And how about the rupee? Do you feel like the floor is in yet? It's been fairly weak recently.
So yes, we've seen recent weakness, but at the same point of time, you have a domestic macro which is supporting. You have global growth which is weakening. So that kind of supports for a stable currency. At the same point of time, RBI has been very active in ensuring you don't see excessive volatility in the rupee. You have forex reserves which are sufficient enough for RBI to support the rupee at the same point of time. So I would expect where historically, we would have seen a 3.5% depreciation of the rupee to dollar over a medium-term, longer-term time period. Going forward, that should actually be much lower than what we have seen historically, leaving aside the temporary volatility that we would have seen or the slight weakness we would have seen. But if I am looking at from a 1 year perspective, I guess rupee is going to be fairly stable.
All right, Shweta Rajani, head of mutual funds at Anand Rathi Wealth. Thank you so much for joining us today with your insights. Let's take a look at how U.S. Treasuries are tracking at the moment. We did see a fair bit of movement on this idea that President Trump was moving to remove Fed Governor Lisa Cook. Well, we've since heard from Lisa Cook. She says the president has no authority to force her to step down or fire her. She says she won't resign, and she intends to carry out her duties to help the American economy, as I have been doing since 2022. So this is a statement from Lisa Cook. We've also heard from her lawyers, who are somewhat more colourful, saying that President Trump has taken to social media once again to fire by tweet and will take whatever actions necessary to prevent that action. Before we go, here's a preview of tomorrow's show. Nomura Sonal Varma joins us to discuss the outlook for India's economy, and that's as the White House plans to push ahead with higher tariffs due in less than 24 hours' time. That is it for Insight. Horizons Middle East and Africa are up next. This is Bloomberg.